Let me start with a number that most people are not paying attention to, but absolutely should. Not oil, not inflation, something far more revealing. 17%. That's the total return of the S&P 500 across the entire 1970s. 10 full years. And just 17%. In a normal bull market, you can get that in a single year. So what went wrong back then? The answer is simple, but uncomfortable. The global economy was trapped in stagflation. Oil shocks hit repeatedly. Inflation stayed stubbornly high. The Federal Reserve was stuck between conflicting priorities, and markets essentially went sideways while the cost of living kept climbing. Now here's where it gets serious. Just last week, Renaissance Macro Research published a note saying that the similarities between today 2026 and the 1970s are the most compelling they've seen in 4 decades. Think about that. Oil above $100, inflation that refuses to cool, growth slowing down, a weakening dollar, and a stock market being carried by a narrow group of expensive tech companies. I've spent decades studying market cycles, and when patterns start repeating this clearly, you don't ignore them. You stop, you analyze, and you prepare. Because this isn't about headlines, it's about understanding the mechanism underneath everything that's happening. Today, I'm not here to scare you. Panic is useless. But I am going to walk you through the numbers, and numbers don't care how you feel. Most investors right now are asking the wrong question. They're asking, will oil hit $200? That's not the real issue. The real issue is what happens along the way. What happens at $110, at $130, at $150? Because markets don't wait for the final outcome, they react to the sequence. And right now, that sequence is already unfolding. Goldman Sachs recently reported that oil flows through the Strait of Hormuz have dropped to just 5% of normal levels. That's not a small disruption, that's a shock to the entire global system. The net impact? A loss of 11.4 million barrels per day from global supply. To put that into perspective, that number alone exceeds what Goldman originally forecasted for the entire year of 2026. Meanwhile, Brent crude has already crossed $110, and WTI has moved above $100 for the first time in years. But here's the number you really need to understand. For every $10 increase in oil prices, inflation rises by about 0.7 percentage points. That's not speculation, that's historical data from S&P Global. Now do the math with me. Before this crisis began, oil was sitting in the mid-minus $70s. Now it's at $110. That's roughly a $35 increase. Multiply that by 0.7, and you get about 2.5 percentage points of additional inflation just from oil. And that's on top of what was already there. Core inflation was already running at 3%, which is already above the Fed's target. Add another 2.5%, and suddenly you're looking at inflation levels that are not just uncomfortable, they're structurally dangerous. This isn't a prediction. It's arithmetic, and the data is already confirming it. The OECD has raised its inflation forecast to 4.2%. Goldman Sachs increased its U.S. inflation outlook in a single update. Prediction markets are assigning a 35% chance to oil hitting $140 and even a 13% chance of $200. These aren't fringe opinions. These are people putting real money behind these probabilities. And according to Oxford Economics, $140 oil isn't just high, it's a breaking point. It's the level where a global recession stops being a possibility and becomes the base case. But here's the part most investors are still missing. Even if oil never reaches $200, the path to $130 alone has consequences that are not priced into most portfolios. Because again, markets don't wait, they move ahead of outcomes. And right now, that movement is signaling something serious. The system is under pressure. And one of the biggest pressure points is something most headlines are oversimplifying: the Strait of Hormuz. This isn't just a geographic choke point, it's a critical leverage point for the entire global economy. At its narrowest, it's only 21 miles wide. Yet every single day, around 20 million barrels of oil pass through it. That's roughly 20% of global seaborne oil supply. Countries like Saudi Arabia, Iraq, and the UAE rely heavily on this route. And here's what makes it so powerful. Disruption doesn't require a full-scale war. It only requires enough risk to make insurers pull back. And that's already happening. Insurance premiums for ships passing through the strait have jumped sharply in just days. At some point, it stops making economic sense for shipping companies to operate there at all. And when that happens, supply doesn't just slow, it collapses. Iran has already launched multiple attacks on commercial vessels, and while alternative routes exist, they can only handle a fraction of the normal volume. That leaves millions of barrels per day exposed to disruption, and we're already seeing the ripple effects. Energy prices in Asia are surging. Jet fuel costs are climbing. Countries are starting to restrict exports to protect their own supply. This is how a localized disruption becomes a global problem. And yet, as Bloomberg recently pointed out, most of the world still hasn't fully grasped how serious this situation is. Markets are still pricing in best-case scenarios, but those scenarios are becoming less likely with each passing day. Goldman Sachs has warned that if safe passage isn't restored soon, oil could test $150. And if it stays elevated, the consequences compound quickly. So let me be very clear. I'm not here to tell you where oil will go. I'm here to show you how the system reacts as it moves. Because that reaction is already underway. And understanding it is the difference between being prepared and being caught off guard. Right now, the chain reaction has started, and most investors are still focused on the wrong endpoint instead of the path that leads there. Now let's move to what I believe is the most important part of this entire situation. And it's not oil itself. It's the position of the Federal Reserve. Because everything we've talked about so far, oil shocks, inflation pressure, supply disruptions, eventually funnels into one central question. What can the Fed actually do about it? And the honest answer right now is not much. Before this conflict even began, markets were comfortably pricing in 2 interest rate cuts for 2026. Investors were expecting relief. There was a general assumption that if growth slowed, the Fed would step in, lower rates, and support asset prices just like it has done many times before. That expectation was baked into valuations at the start of the year. But fast forward to today, and that entire framework has shifted. According to the latest CME FedWatch data, there is now an overwhelming probability that the Fed will hold rates steady at its upcoming meeting, not hold. And, more importantly, the conversation has moved from how many cuts to what if there are none at all this year. This is where things start to change at a structural level. Because for years, markets have relied on something often referred to as the Fed put. The idea that when conditions deteriorate, the central bank will step in to stabilize markets by lowering rates or injecting liquidity. That safety net has been one of the most powerful forces supporting asset prices over the past decade. But right now, that safety net is effectively suspended. And the reason is simple but critical. When inflation is the main problem, cutting rates makes things worse, not better. Lower rates mean cheaper money, more spending, and more demand in an environment where supply is already constrained. In other words, it fuels the very inflation the Fed is trying to control. And when that inflation is being driven by oil, something monetary policy cannot directly fix, the Fed becomes even more constrained. Think about the position they're in. Growth is slowing, with GDP projections now sitting below 1% for 2026. At the same time, inflation expectations are rising, not falling. That combination, low growth and high inflation, is exactly what defines stagflation, and it's one of the most difficult economic environments to manage. Because every tool the Fed has comes with a trade-off. If they cut rates to support growth, they risk pushing inflation even higher. If they keep rates elevated to fight inflation, they risk slowing the economy further. There is no easy path. And that's exactly why comparisons to the 1970s are becoming more frequent. Back then, the Fed faced the same dilemma, and for years, it hesitated trying to balance both sides without fully committing to either. The result was prolonged economic stagnation, declining real returns, and a market environment that frustrated investors for nearly a decade. It wasn't until Paul Volcker stepped in and aggressively raised rates, what he himself described as shock therapy, that inflation was finally brought under control. But that solution came at a cost. It triggered a deep recession and significant market volatility. And today, the Fed is trying to avoid repeating that outcome, which makes its position even more complicated. Analysts like Ed Yardeni are now assigning a meaningful probability around 35% to a return of 1970s-style stagflation. And when you look at the data, it's not hard to see why. The structure of today's market makes it particularly sensitive to interest rates. The technology sector alone accounts for roughly one-third of the S&P 500. These are companies with high valuations, where a large portion of their worth is based on future earnings. And when interest rates stay high or even just fail to fall, the present value of those future earnings declines. That's not a theory. It's basic discounted cash flow mathematics. We're already seeing this play out in real time. Major technology companies have experienced sharp declines, with some dropping significantly in just the first quarter of the year. The broader market is under pressure, volatility has increased, and bond yields have moved higher. At the same time, consumer confidence is weakening, signaling that demand may start to slow. When you combine these factors, higher rates, declining valuations, and softer demand, you create the conditions for what's known as multiple compression. That's when investors are no longer willing to pay high prices for earnings, leading to lower stock prices even if the companies themselves remain fundamentally strong. And when that happens across a large portion of the market, it can lead to a prolonged period of stagnation, not because of a single event, but because of the interaction between multiple pressures happening at once. Now let's talk about where money is actually moving in this environment, because this is where understanding the mechanism becomes actionable. Energy, unsurprisingly, is one of the biggest beneficiaries. As prices rise, companies involved in production and distribution see direct gains. Infrastructure within the energy sector is particularly resilient because these businesses often operate like toll systems, earning revenue based on volume rather than price alone. Defense is another area seeing increased attention, especially companies involved in supplying and replenishing military equipment. On the other side, there are clear structural losers. Airlines, for example, face rising fuel costs that directly impact profitability. High-growth technology companies remain under pressure due to their sensitivity to interest rates, and consumer discretionary sectors are being squeezed as households deal with higher living costs and reduced savings. But perhaps the most interesting part of this shift is the group of companies that tend to hold up better than expected. These are businesses with strong pricing power, companies that can pass higher costs onto consumers without significantly reducing demand. Sectors like healthcare, essential industrials, agriculture, and certain high-dividend stocks fall into this category. These are not necessarily the fastest-growing areas of the market, but they are structured to operate more effectively in an environment where inflation is persistent and growth is uncertain. And this is where the difference between reacting emotionally and thinking structurally becomes critical, because what we're seeing right now is not a temporary shock, it's a sequence of events that feeds into itself. Oil disruption leads to higher inflation. Higher inflation limits the Fed's ability to cut rates. Higher rates pressure valuations and slow demand. Slower demand impacts earnings. And that entire cycle reinforces itself over time. This is why I keep emphasizing that we are not dealing with a single event. We are in a sequence. And once that sequence starts, it doesn't resolve quickly. It evolves. It spreads. And it forces investors to adjust in ways that may feel uncomfortable at first, but are necessary for navigating the environment effectively. The key question now is not whether the Fed will act, It's whether it even has the flexibility to act in the way markets have come to expect. Because right now, all the evidence suggests that flexibility is limited, and that changes everything. So where does all of this leave us? After looking at the oil shock, the supply disruptions, and the Federal Reserve's increasingly limited room to respond, we arrive at a point that many investors are still struggling to fully accept. This is not a short-term disturbance that fades once headlines move on. This is a structural shift that is already unfolding. The sequence has begun, and the data is confirming it step by step. Oil is holding above $110. Equity markets are under pressure. The Fed is choosing to hold rates instead of cutting them. Inflation forecasts are being revised upward across major institutions. And the probability of stagflation, something most investors have not had to deal with in decades, is rising in a measurable, tangible way. These are not isolated signals. These are coordinates. And when you put them together, they describe an environment that is fundamentally different from what most portfolios are currently positioned for. This is exactly why I keep returning to the 1970s, not because history repeats perfectly, but because it often rhymes in structure. That decade was defined by a combination that investors rarely see but must take seriously when it appears: rising costs, slowing growth, and limited policy support. It was one of the few periods in modern financial history where both stocks and bonds struggled at the same time. Traditional diversification didn't work the way people expected. The strategies that succeeded were not based on chasing growth at any price, but on adapting to the reality of the environment. Investors who recognized what was happening shifted toward assets that could survive inflation, generate real income, and maintain value even as conditions became more difficult. And those who didn't adapt spent years watching their portfolios stagnate while purchasing power declined quietly in the background. Now bring that framework into today. The conditions are not identical, but the mechanism is becoming increasingly familiar. We are seeing a supply-driven inflation shock, largely tied to energy. We are seeing a central bank that cannot easily respond without creating additional problems. And we are seeing a market structure that is heavily dependent on sectors that are sensitive to interest rates and valuation changes. This combination creates a kind of tension in the system that doesn't resolve quickly. Instead, it forces adjustments over time. It changes how capital flows. It shifts leadership within the market, and it challenges assumptions that have worked for years but may not hold up under these conditions. Let me be direct about what I believe this means. The idea that the Fed will step in to support markets at the first sign of weakness is no longer something you can rely on in the same way. The so-called Fed put is not permanently gone, but in an environment where inflation is being driven by external supply shocks, especially oil, it becomes far less effective. Monetary policy cannot produce more energy supply. It cannot reopen disrupted shipping routes. And it cannot quickly reverse inflation that is being pushed higher by real-world constraints. That limitation matters because it removes one of the key pillars that has supported market behavior over the past decade. And when that pillar weakens, everything built on top of it has to adjust. At the same time, this is not a call for panic or extreme positioning. The goal is not to react emotionally to every development, but to understand the structure of what is happening and align accordingly. Because even in challenging environments, there are always areas of resilience. There are always sectors and strategies that perform better than others, not because they are immune to pressure, but because they are better aligned with the conditions. Companies with strong pricing power, for example, can maintain margins even as costs rise. Businesses tied to essential services or commodities can benefit from the same forces that are creating challenges elsewhere. And assets that generate consistent income can provide stability when growth becomes less predictable. The key difference between investors who navigate periods like this successfully and those who struggle is not access to information, it's interpretation. It's the ability to see beyond individual headlines and understand the broader mechanism at work. Right now, that mechanism is driven by a sequence that starts with energy disruption, feeds into inflation, constrains policy